Okay. All right. How's everybody doing today? I think I've got you guys muted, so I may not hear your response, but I'm glad you have joined us. This is our final and last class of our business accounting training series that has been brought to you by the Eastern Market Corporation, Lake Trust Credit Union, and Ashton, BC, myself, who is Dale Grant. So far in this series, which we have recorded, and we also have PowerPoints as well as other documents that have been shared with Christine. So if you have not seen all of them, you can always contact Christine Kwan at Eastern Market Corporation, and she can provide those documents to you as well. But so far, we've discussed, we've talked about the financial statements that are most commonly used with the four primary financial statements. We've talked about the documents that are most commonly requested when requesting loans. That's going to be your full set of financial statements, your balance sheet, your profit and loss statement, your statement of retained earnings, your cash flow statement, as well as your AR agent reports. So we talked about what those are. We talked about the systems in which to prepare those reports. As I mentioned previously, I'm a big proponent of QuickBooks, though that's not the only one to use. That's my preferred software system to use. So we've talked about how you can develop those financial statements in QuickBooks. And then we went on and talked about how we can use the information that we've developed in QuickBooks to build out 3-year cash flow projections. So we can look at our historical information, and we can take that historical information and we can add on assumptions that we may have as far as occurrences that will happen to our business in the future and how that affects us. So what are those 3-year cash flow projections? And then finally, last week, we talked about what your personal financial statements were, as well as sources and uses when talking with a lender. And we're going to wrap this up this week by talking about records retention. So what type of documents should you be holding on to? What are the various methods for retaining documents? And then we're going to do a very, very high level look at the type of tax returns that you may see or have to file as a business owner. So we're not going to do a deep dive into taxes because we could do a whole 5-week training series on just taxes alone. But I do want to at least give some introductory to the taxes as well. So to get started with that, we're going to go ahead and start off with records retention. All right, so once again, if anybody wants to reach out for questions, I always have my contact information at the beginning of the PowerPoint presentations. At the end, you will also see my social media pages. Feel free to call, email, text, or send a message via social media, and I'm always available. So with this one, record keeping, we're going to talk about key points. What are some of the records you should retain? How long should you keep records? And that's actually going to be important with what's going on right now. Methods to retain records. And then also, I want you to be thinking about disaster recovery. So one of the things that I believe are important is that even though we may think of ourselves as small business, we need to behave like big business and how the large players do. Sometimes that can mean what our web presence or social media presence looks like, just to make sure you have one that's professional, that looks like all the other players in the game. Sometimes that means the documents that you are using to provide to end users, such as invoices, things of that nature. And the same as it may go for records retention. So as I was telling someone else, someone who was interested in getting consulting I was telling them, think about how the business you worked for operated, how they kept their documents, how they organized their files. They did that for a reason. They had been in business for a while. They had been successful enough to hire employees. So use that as a model. I know I've used that as a model. So, if I were to show you what my internal document organization looks like, it looks very familiar to what I saw in corporate America. And I don't think that's a bad thing. So those are, and I say that because I know a lot of us are running away from corporate America as fast as possible. And so we don't necessarily want to espouse a lot of those things, but we do want to take those positive experiences and make sure that we are using those in our everyday businesses. In our everyday business, rather. And that's sort of what we're getting here. So once again, we're going to talk about those records retained, how long records should be kept, methods to retain records, and then disaster recovery. So what type of records do we need to hold on to? Legal documents. Anytime you have any sort of legally binding document, and we're going to get into this later on, but I'm just going to say this now, you're going to want electronic formats of documents. Even if you don't have a copier, there are apps that you can use on your smartphone that can take images of pictures and turn it into a scannable document. But ultimately, you want to figure out some way to have an electronic version of those documents just because it's a lot easier to maintain in our society. And then with that said, there probably are some documents that you're going to want to have a hard copy of. So ultimately, that's going to be that you're going to have to make that determination. But type of records you want to retain, all of your legal documents, anything that's legally binding. I mean, I don't need to harp on this one too hard, but we know that we need to keep all of our legal documents, all of our compliance documents. I think that is very important moving forward as we talk about a post-COVID society and we look at health records. Are we compliant with standards, especially if we have locations where people are coming into it and we have to maintain certain protocols and certain standards? If there is a compliance document, if there is a document that indicates that you've had some sort of review or audit or someone has looked at it, anything that says that you are in compliance or that can certify that, that's also important. Financial documents, once again, a lot of this stuff is online. But, for instance, when I prepare taxes, I make sure that the financial statements that was used to prepare those taxes are retained. I do that because in QuickBooks, you can go in there and change prior year information. So I need to make sure that I have a paper trail, a hard copy trail, even if it's electronic, that directly supports the work that I have done. So that's what I'm talking about with regards to financial documents. As you are applying for grants, loans, the loan package, the document package that you have applied for, I would keep that in a folder. I have applied for, personally, I've applied for certifications, things of that nature. A lot of times they ask for the same information. And so being able to just pull on and being able to pull that same information saved me a lot of time. Tax returns. The IRS can can audit taxes as far back as 3 years. If they feel that you have underreported your tax liability by 25% or more, they can go back 6 years in total. So I would say keep 6 years of tax returns. You want to make sure you keep these documents. Right now, what we're seeing, just anecdotally and as a firm, is that a lot of people are getting notices that that are showing reviews of tax returns for 2018. And it wasn't until I got the third or fourth document from a client that, I may have prepared their return or not. It just happened since I'll get they've got a letter from the IRS. They all went back to 2018 and I realized, oh, it's 2021. They're going back 3 years. Oh, we just came off a period of significant government stimulus to corporations and to individuals, it makes sense that there is a need to have increased revenue for the federal government. They're going back their full 3 years. Okay, in some instances, they're making a correct argument. In some instances, they're making an incorrect argument. In both instances, they're making an argument, and we have to have those documents to go back and refer to so that we can make a determination if it's correct or not. So you want to make sure you hold on to that. And then any business operation documents. That's a big one. If you have a partnership, you're going to have an operating agreement. You're going to want to make sure you have that. You know what's in the operating agreement because that dictates who owns what, who owes what, who's responsible for what. If there are shares of stock because you have an S corp or a C corp, that's going to show who owns what. So you want to make sure you have those business operation documents. They could be lease agreements. Once again, for those people that got PPP loans, some of those loans were supported by rental agreements. And in order to qualify for forgiveness, the rental agreements had to be provided. So if you didn't have them, or if it wasn't a formalized rental agreement, you don't have anything to show, that impacts whether or not you can get the forgiveness on that loan. For many people who took the PPP loan, the forgiveness aspect was, the big attraction to getting that loan. So you want to make sure that you're retaining these types of documents. All of those documents that you may need to refer back to for just more information or supporting documentation for something that you need to provide, anything of that nature, I would hold on to it. And then once again, hard copies are really important, but I would definitely have an electronic copy. And we're gonna get into this further, but so I'll wait till we get into that actually. Legal documents. So your articles of organization, we mentioned the operating agreement, contracts. Contracts go without saying, but make sure you're holding on to them. Even, if you think that it's ironclad, hold on to them. Settlements, settlement agreements. I know that, this is food focused, but there are a lot of people who are into real estate. You're buying property, you're flipping property, you receive that settlement agreement. That settlement agreement tells, you deal with it a lot. You're gonna need it for tax purposes, not only income tax, potentially property tax. You may need to prove that you no longer own the property or that you still do own the property. Those settlement agreements are important. And then any other binding agreements, and with these legal documents, anything that can bind you to someone else, require that you have to pay, I would definitely hold on to it because, you never know when you need to refer back to those documents and correct someone for not providing the correct information to you. Compliance. So we touched on this as it pertains to COVID, but once again, with being food-related businesses, you've got the health board, if you've got a kitchen, if you've got a restaurant. So regulatory and compliance is a major factor in your particular industry. Especially, I know that some of you may be renting a kitchen, and that's a big advantage to renting the kitchen is that party, that entity that is renting the kitchen to you, they're taking on that risk. Once you begin to venture out and open up your own kitchen, maintaining those health standards will become a major issue. So not only do you want to make sure you're retaining those records, you want to make sure that you are consistently in compliance, that you know what the compliance rules are, and that you are maintaining the schedules that you need. And also, once again, retaining those records for anyone that may ask. State, federal, and local government. Some of you may receive grants. Some of you may have governmental contracts. So once again, you want to have that. Licensing and permits. As you know, that's a big part of your business. Food trucks, you got to have licenses. Food preparers, so you already are aware of that. And then once again, any documents that support your compliance requirements. You want to make sure you're retaining this stuff. And I can't stress enough. I mean, it's very easy to receive a letter in the mail, see it, and then throw it into a file folder. Okay. The issue is that that's a very good way for that letter to get misplaced. Having a system of being able to turn that letter into an electronic document and put it into an organized file that is, cloud-based, that, is easily identifiable, state compliance requirements. You've got it. Because once again, for those of you who have not made that jump into a restaurant or to a physical location, you never know when you may need to provide those type of documents. So I can't stress that enough, how important that is. Financial records, we touched on it. Financial statements, your current and prior period. Once again, with QuickBooks, this is going to be cloud-based. So you'll have a lot of that stuff, but if you're just getting physical copies from a tax preparer, you're going to need that information. If you're looking to get a loan, if you're looking to apply for a grant, lenders, investors, anyone who looks at your financial statements, they're going to want to see it for a few years. They're going to ask for at least 3 years of financial statements. So you're going to want to have that prior stuff. So if you've gone through the trouble, maybe you don't have a dedicated QuickBooks account, but you did go through the trouble of getting financial statements put together and someone provided it to you, make sure you're retaining it. Sometimes I see clients, they get financial statements because they have a need right now. And I just don't know if they're keeping up with that stuff after they've addressed that right down need. So if they're not, I hope that they do. Financial commitments, of course, you want to make sure you're managing your debts and receivables, any investments you have out there, and then once again, any shares of ownership. Make sure that you have a written record of shares of ownership and that all owners are in agreement. You don't want to be, running a business and you thinking you own a different percentage of the business than what the other partner believes that you own. That should be clear. It should be stated, and especially because a lot of us, we start businesses with people that we know. And so and I always have to say this, I'm a CPA. I cannot give legal advice. So I do not give legal advice. And when you get into sort of the agreements, now we're kind of talking about legal advice, but specifically as it talks about the operating agreement with shares of ownership is included in the operating agreement. As you're starting businesses and you're working with people that you know, I'm a firm believer in that having that written down and agreed to when everyone's in a great place at the beginning of the business will help things out as you move down the road in the business. By giving defined roles, it will help alleviate some, maybe not all, but some of the stress of ownership of a business with another person, and especially another person that you know personally. So, tax, EIN. The IRS will send you a letter. They'll give you an electronic copy of the EIN, and then after that, it's a little bit more, you have to request one. It's a little bit more of a hassle to get your EIN number. So if you lose that number, it's going to be hard to get it. Prior to your tax returns, you can always go onto the IRS website and request tax returns. We'll talk about tax some more, but just a quick tip. When doing anything tax related, the website should end in .gov. Now, if you start off on the IRS website, irs.gov, it may redirect you to a third-party website. That, of course, is okay because you started off on the .gov website. But the key is anything IRS, as long as it's .gov, you can trust it. But you'll want to retain your prior year returns. Even for your tax preparer, he just may want to, your tax preparer may just want to review prior year returns just to make sure that there is consistent application of tax strategy from year to year and that nothing else has been missed. So make sure you retain that. Any documents that contain tax information, and then correspondence with the taxing authority. Once again, I'm saying that right now, during a period of time in which the IRS is more aggressive with their collections. I've got one client where they are dead set on collecting on some money that we already have documentation that says they agree we don't owe them, but all the departments don't talk to one another. So, it's once again me following up and saying, hey, you guys already said we're good to go. So I think that you need to speak with this other document. But we can make that argument because we retained our correspondence. If we didn't retain that correspondence, we would have been told, all we would have been able to say was, hey, I believe we saw this and I lost it. Can you help me out? And they're going to say no. Instead, you owe us this cash. But because we have this document, we can continue to make the argument that says, no, we're in the right, you're in the wrong. What I remind people. Yes.
Question. What if you have been running your business for a couple of years and you haven't been reporting income to the IRS?
So.
And is there any, to start again or to start after you've been in business, is there any downside to that? Will they come after back income?
So the question is, because sometimes the questions don't always come through the Zoom. If you have been in business for a significant period of time, but you have not filed prior year tax returns, what should you do? And I receive that question a lot, and it doesn't have an easy and clean answer. What I can tell you is that the state of Michigan explicitly states on their website that they withhold the right to go back 4 years and review if you have prepared tax returns. The IRS does not explicitly state the period of time which they go back. However, as I stated earlier, the regulations state that the IRS withholds 3 years to go back and audit a return, 6 years if they feel you have underreported your tax return, your tax liability rather, by 25% or more, which that's different than saying if you owe back taxes, how far should you go back? So with that being said, it's a very difficult question to answer. What I would say is that's something that should be answered on a case-by-case basis, looking at what your particular tax situation is and what has happened in the past and what you have done in the past. But I can really only tell you that once again, the state of Michigan, they reserve the right to go back 4 years. The IRS says 3 to 6 years. So the most prudent advice would be to go back at least 6 years or 4 years. But once again, I would say if you were in that particular situation, you should be speaking with the tax professional on a one-on-one, and that's just too difficult of a question to answer in this particular setting. Let's see here. So business operations, invoices while they're outstanding, and then for a period of time after that, there are times when clients may ask me about invoices, or they may ask what were the billable hours in the invoice. I retain those records. I could say, I billed you these hours in this particular month. This is the work that I did. So being able to retain those records and then provide it upon request, it really just sort of bolsters, it makes you look good as a professional, I believe. Receipts, people ask me about receipts a lot. I think that my opinion is that we are changing as a society. In QuickBooks, I link the QuickBooks to your bank statements. if you use your debit card, that debit card typically is very clear about where the purchases are. So I don't always request, well, I don't request receipts if it's primarily debit card use, because it's going to say Office Max. I know it's office supplies. It's going to say allpro.com. I know it's signage. Now, if it says Amazon, I don't know. It could be anything. If it says ATM withdrawal, I don't know. It could be anything. So what I like to tell people is, if you're shopping from places to where it's not clear what the purchases are, you're going to want to retain those receipts. If it is clear, you're probably good with the bank statements. Once again, agreements, contracts, any policies. As you grow, as you hire more people and you need to institute policies, maybe HR policies or safety policies or OSHA policies, they need to be documented. They need to be documented, they need to be followed, because in the event of an audit, that's what we're gonna look at. And we're talking about a financial audit. They may, let's say for instance, you had an employee and you needed to discipline them, and there were 2 employees, and the one employee, you needed to discipline them and you fired them immediately. But the other employee, you gave them a verbal warning, a written warning, and then you fired them. Well, what was the policy? And if you have a written policy and you shouldn't have fired the one employee right off the bat, you may have an issue. If you don't have a written policy, you may have an issue because you're treating the different employees differently. So, that is something that you will need to think about as you grow, and that will definitely be a record you will need to retain. Records, how should records be kept? Electronically. I definitely think, I do keep hard copy records. I have hard copy records, especially tax returns. I manage those. I will probably at one point grow to need to use an Iron Mountain or a document management company. For your purposes, I definitely suggest that you utilize an electronic means. If you can scan documents and then save those documents to the cloud. It's always good to have a hard copy backup or even to have a USB backup, but if it's cloud-based, theoretically, you should always be able to access it. Now, I'm not an IT person or, extraordinarily tech savvy, but personally, I am currently using cloud-based management systems, and I do believe in them. It is your responsibility to know the appropriate retention period. So while I provide guidelines for how long you should keep things, ultimately, as the business owner, it's your responsibility. If that document provides a specific date range, you should defer to that specific date range versus what the average range of maintaining something is. So it is also your responsibility as a business owner to provide support of record retention upon request. Once again, as I mentioned in the other examples, you're going to, in the event that you need this type of documentation, it's because someone has asked you to prove something. And if you don't have these documents, it's going to be more difficult for you to prove that you were in compliance or you did what you were supposed to do or what your side of the argument is. So you need to keep that in mind as it regards to record retention. Can you get to it easy? But also, is it easy to maintain? If it's difficult to maintain, you're not going to do it. So you want a mix of those two things. Record and retention period, I'm going to go through this quickly because I still want to get into the tax period, the tax portion rather, but invoices and receivables, if this is outstanding, this was, I found this doing some research in this, so this is just sort of some ideas. Invoices and receivables, I don't necessarily agree if you need to keep invoices and receivables for 5 years. I would keep them while they're outstanding. And then once they're paid, once the other party pays, or once you have paid, I would think that you're good to go, at least for the year. Auditors' reports, absolutely, I keep that permanently. Annual statements, especially if they are tied to the tax returns, I would definitely keep that permanently. Inventory, I would most likely keep inventory for, I would keep that current. As long as, well, I would want my inventory to be current up to the year, but you should be managing your inventory. Personnel payroll records, you may want to keep that 6 years. As I said, I found this during research, but personnel payroll records, that's going to be that W-2 information. Now, retaining that information may fall onto your payroll provider. So if you're using, and I tell people, especially with payroll, because there's a lot of compliance with payroll, I like to go with the big players in the industry. So I hope that they're keeping that information for 6 years, because that is something that the IRS, the state, they look at payroll information. So those records are definitely something that you're going to need to look at. Contracts, 4 to 5 years, I feel like that's safe. You never know when someone may sue you over a contract. So just because you have fulfilled a contract, I would not necessarily get rid of that contract. I would hold on to it for, a decent period of time. Once again, that's something that's going to be at your discretion. Personnel files, same deal. You want to hold on to, especially I know with the state and with people that file for unemployment, they may make requests from the state for unemployment. They may need to look at your personnel records. The state may need to look at your personnel records, so you need to hold on to that. Insurance records. If you were to have an insurance claim, I definitely hold on to that. Time cards are dated, so I'm not too concerned with that. Retirement plans, you should hold on to that permanently, but once again, that's a little bit more dated. So business and legal, we kind of talked about a lot of this stuff. Once again, I do want to get over to the tax portion, but you kind of get the idea. You're going to use this at your discretion. Taxes, I would hold on all tax returns permanently. Definitely, I would hold on to those for you never know how long you're going to need those. How to store your information. You can use physical storage. I am a fan of manila folders and banker's boxes. Do not get me wrong. Physical storage is important. You have electronic storage. You may have a jump drive, a USB drive, and then of course cloud-based. You may be using, I think it's iDrive or Google Storage. I would definitely be looking at those different options. Physical storage is going to be file folders, the accordion folders, a ticker folders, a cabinet, a banker's box, a fireproof box. So that's much more old school. It takes us up a lot more space. I wouldn't be too focused on that. I look more into electronic storage. I definitely have a scanner. I think that's one of those sort of electronics that every office should have. Copy machine, I don't know, you don't necessarily need that. Fax machine, not so much, but definitely a scanner. A shared company folder that is organized by department. Shared company folders are awesome because now you're uploading the same documents, you're working from the same documents. So if you've got remote employees, administrative assistants, or people that are doing back office work, I'd look at a shared company folder, and then maybe some specific software that you're using to organize your documents. But once again, I'm a big fan of cloud-based software. You can access it anywhere. You can get it from your smartphone. You can get it from your laptop. I know that it's helped me out tremendously. There are times when, I've literally been out of town and been able to address client needs because my documents are saved on a cloud-based drive, and they are secure. So, it meets both of those needs for me. I think that's very important. Last thing we're going to talk about, very quick, disaster recovery. Disaster recovery is being able to retain or get to those documents in the event of a disaster. God forbid, what happens if there's a fire, if there's a flood. We've been seeing what's happening with the rains in the city lately. A flood could happen. You are cooking items. Something could happen. So you want to make sure that your important documents, your insurance policy, your lease agreement, your outstanding invoices, you have a way to retrieve those documents in the event of a disaster. So cloud-based, that kind of helps out a lot with that. But the whole idea of disaster recovery is that if something were to happen, can you get back on your feet in the quickest time possible? So as we looked at those other methods of retaining documents, if it's physical and it's in location and that fire, that flood happened, it's gone. Same thing with electronic. If it's stuck on a laptop or a USB drive, it's gone. If it's cloud-based, you may be able to get to it again. That's just something to think about as you are thinking about those disaster recovery methods and what is your disaster recovery plan. Once again, there are commitments that as business owners you have either made or requirements to maintain those commitments, and you want to make sure that even in the worst of times, you can still keep business going and be able to get yourself out of those worst times. So that's the overview of the disaster recovery and records to retain. I see we got some more people in here into the room, as I mentioned. So this is in conjunction with Eastern Market Corporation, Lake Trust Credit Union, and Ashton Business Consulting. My name is Dale Grant. I am a CPA. I focus on businesses, individuals, and nonprofits in the Metro Detroit area, providing accounting, tax, and bookkeeping and advisory services. So we're going to end this particular PowerPoint, and then we're going to move on to the next one. And I think that we also have a question. Do we have a question? I asked for it. Do we have a question from Marie? No? Okay. All right. So I'm going to stop the share here, and we're going to take just a quick break. So this is just a high-level view of tax forms required for most small businesses. Once again, here's my contact information. So before we get started, the main concept that I want to discuss with regards to taxes is the concept of being a flow-through organization. What that means is that your business does not actually pay taxes. Instead, the income that is earned or the losses that are incurred by your business flows through to your personal tax return. And it is there you will pay taxes. So let's say, for instance, your business earns net income $30,000. You would have a tax return for that business, but that $30,000 would be included on your personal tax return. And it is there you will pay taxes. Okay, so that's the first one. I'd like you to think about that when we talk about tax returns as a flow through. The next concept that I'd like you to think about is that your tax liability for your business is based off of the net income of the business. So what does that mean? We talked about previously your profit and loss statement. It has the revenue, which is all the money your business earned, less your cost of goods sold, which is what it costs you to provide your product or service, less your operating expenses, what it costs you to run your business, equals your net income. That's the money that's left over. That number is what your tax liability is based off of. So let's put that another way. Let's say, for instance, your net income for the year is $50,000. But then let's also say that you left $10,000 in the bank account for upcoming expenses. when we calculate your tax liability, it will be based off of $50,000, not $40,000, because you are taxed off of the net income. It does not matter that you personally did not take the $10,000 out and that you left it in the bank. Okay? So that's just something to keep in mind, is that your tax liability will always be based off of the net income of the business. What you take out of the business is not as important. So there are different entity types for businesses. Some of you are sole proprietors. So here's one last concept. The federal government does not recognize the LLC designation. So a lot of you may be LLCs. Some of you are single member LLCs. Some of you are multi-member LLCs. That is what's known as a state designation. In the eyes of the government, you are either a sole proprietor, a partnership, an S corp, or a C corp. If you are a sole proprietor, or as many of you may think of it, a single member LLC, your tax return is going to be the 1040 with the Schedule C, as indicated at the top. If you are a partnership, your tax return will be the 1065. If you are an S corp, your tax return will be the 1120S. If you are a C corp, which is like the GM and Amazon of the world, you will be an 1120. You will also have state and local taxes. So for instance, the city of Detroit has local taxes. If you live in the city of Southfield, you don't have local taxes. And then if you provide prepared food, so cooked, in packaging with utensils, you may be subject to sales tax. So let's talk about those. 1040 with the Schedule C. This is going to be for my sole proprietors, my single member LLCs. Your business return is the Schedule C. It essentially is the IRS's version of a profit and loss statement. It's going to have the same profit and loss information on there. On your tax return, you may have additional expenses that do not show up on your financial statements, on your financial profit and loss statement. That may include mileage. So mileage is a tax deductible expense that we might not have on our profit and loss statement. The other is business use of home. The IRS allows you to use a portion of your home home expense if you have a home office. That would not show up on your business's profit and loss statement. So, but that would be on the Schedule C. The Schedule C is the IRS profit and loss statement and the net income number that once we look at what's on the financial statements and then we add in the tax deductible expenses, that net income number on the Schedule C will then appear on the first page of your 1040 as business income or loss. So it is added to your W-2 income. So let's say, for instance, you have a job and a side business. You will see on that 1040 your W-2 income. Below that, you may have some investment income, some Social Security income. Below that, you'll have your business income. And then below that, they will have your adjusted gross income. Essentially, they've added up all of your different income sources, and that total number will then be used to determine the number they're going to calculate your tax liability on. So, that business income flows through to the front page of your personal tax return. Okay, and it's filed with your tax return. So that is for my single member LLCs or my sole proprietors. My partner, and then once again, But 1040 is due when your personal return is due. So in most years, April 15th, last year was May 15th. We'll see what happens this year. Probably April 15th. I don't see any reason why they would push out the date. If you have a partnership, you will need to file a 1065 tax return. That tax return is due March 15th. So it's due a month early to the business return. All returns can be extended. All extensions are 6 months. So in this case, September 15th is when the extensions are done. The 1065 is a completely separate tax return. That return is, it contains the income statement, and then there is a threshold number in which you may or may not need to include the balance sheet. So at the 1065 level, you will definitely need financial statements because you may or may not include your balance sheet. With the Schedule C, you won't have to. But so it once again gets back into having those financial statements and not only being able to use it to manage your business, but also to prepare your tax returns. The 1065 generates a K1. The K1 indicates the ownership percentage of each partner, as well as their percentage of the income earned or their percentage of the incurred loss, of the losses incurred. That K1 that the 1065 generates and that each partner receives is then used by the partner to complete their 1040 tax return. And on their 1040, the income or loss is reported on the 1040 Schedule E and appears on the front page of that 1040. Once again, W-2, Social Security, investment income, business income, total adjusted gross income. So the 1065 is the partnership return. It shows what the business did, but still it's a flow through. So taxes weren't paid with that return. Rather, that return said, hey, we've got 3 partners. Here's what each partner's percentage of ownership is. Here is their portion of income or loss. You will then use that to prepare your tax return. So that's how the 1065 operates. You will use it if you have a partnership return. And just as a point of note, when you apply for your EIN letter will indicate the type of return you need to file. If you change your ownership type, you will need to file a form with the IRS. You can become an S Corp. If you are a sole proprietor and a friend of yours joins the business, you have automatically become a partnership. You will have to indicate that to the IRS, and so that you can be I guess the wrong term, but allowed to file the correct term. The IRS will look at the EIN number, and without notification, let's say, for instance, you were a single member LLC and then you took on a business partner, now you're a partnership. If you tried to file an incorrect tax return, the IRS will kick it back. So you do want to let them know, hey, things have changed with the business, and here's what it is. 1120S. So now we're not going to get too deep into tax returns, but this is the S Corp, okay? The S Corp files the 1120S. It is due on March 15th, just like the 1065. It generates a K1, just like the 1065. You have the option as a single member LLC and as a sole proprietor, and even as a partnership, to elect to be taxed as an S Corp. Some people elect to become S Corps. So let's quickly talk about the 2 main advantages for an S Corp. One is that With regards to federal taxation, most of us are aware of withholdings tax in the tax brackets. I'm in the 25% tax bracket. I'm in the 24% tax bracket. What we all forget about are self-employment taxes, which are an additional 15%. An S corp allows for owners to be employees. As a single member LLC or as a partnership, you cannot be employees. Once again, you're taxed on the net income. 100%, you're paying withholdings tax on 100% of that net income. As an LLC and partnership, you're paying self-employment tax, that additional 15%, on 100% of that net income number. As an S corp, you have the opportunity to be an employee. As an employee, you will still pay 100% on the net income, the withholdings tax. You're going to pay tax on your salary as an employee, but you will only pay self-employment tax on your salary as an employee. You won't pay self-employment tax on the difference between your salary as an employee and the total net income. So there is some cost savings there. Now, once again, this is a very high level review. So if you have some questions, which I suspect you may, that's quite all right. Reach out to me. We can answer those. But due to time constraints, I can't get into a full example of the savings, but there are tax savings with being an employee versus not being an employee. And that is a primary advantage of the S Corp election. The other advantage of the S Corp election is if you expect to offer equity interest in your business. The S Corp has stocks like the stock market, which means if you want to sell equity interest in your business, you can simply sell somebody 15% worth of stocks. As an LLC or partnership, you will have an operating agreement. In that operating agreement, you will need to have a majority rule agreement to bring in a new partner, and then the operating agreement needs to be amended to include the new partners. So as you can see, it's a lot more administrative work to add in new ownership in that LLC model. As an S Corp, the entity structure allows for much easier transference of ownership. So with the S Corp, you get the tax savings and there's an easier transference of ownership. The final taxation is, oh, you know what? It looks like I did not make a slide for that one. The final taxation is C Corp. That is an 1120. Keep in mind, there's a thing called double taxation with the 1120. So the C Corps are the Fords and the GMs. Oh, you know what? It's the next slide. I apologize. So all of these are flow-throughs. That's what this slide says. The C Corps are the Fords and the GMs of the world. It's a corporate tax return. The corporation will pay taxes. And then any money that you as the owner, you receive from the business will also pay taxes. So that's a double taxation issue. Versus as the S Corp or the 1065, there's just one taxation. With the C Corp, the company pays tax, and then the money you receive as a salary, you pay tax. The dividends you receive, you pay tax. So with the C Corp, I would consult heavily with my tax preparer before choosing the C Corp election right now. And this video is made in Q3 of 2021. We have corporate taxation will be brought up within our political arena, and the taxation rate under the prior administration was fairly low, lower than what it has historically been. So right now for the C Corp, it looks enticing. If the decision is made to raise the corporate tax rate, which potentially could happen, it may not be as enticing. So a lot hinges, on political decisions that are made within the next year or two as to whether or not the 1120 election is still a good election for, especially for small businesses. And so the 1120 is one I would stay away from. The C Corp, I would stay away from that. The S Corp, it makes a lot of sense if it makes sense for your business. But like I tell people, without getting too far in the weeds, you got to be making some money. If you're not making any money, it's not going to make sense to do the S Corp election. But if you're making some money and we're looking for ways to which to lower your tax liability, the C Corp is a good option. One thing that I learned when I was studying accounting and taxation, a good statement is that tax avoidance is legal, tax evasion is illegal. So we are well within our rights to employ strategies that are allowed within the tax law to lower our tax liability. That is things that we do and everyone does it. What we are not within our right to do is to act unlawfully or to misrepresent our income or loss position for tax purposes. So we want to be clear on that, but definitely if there are strategies such as electing to be an 1120S so that I can lower my self-employment tax liability, absolutely go ahead, employ it. And then also, once again, without getting too far into the weeds, we talked about the tax deductible expenses. Employ those as well. If you're looking to get loans, those numbers can be added back in because lenders, end users that are looking at tax returns, they understand what the tax deductible expenses are versus the financial accounting expenses. Final point, we're going to talk about sales tax. If you are selling prepared food items, once again, it's packaged, it's piping hot, it's delicious, it's got a fork and knife with it and a napkin, you're going to have sales tax associated with it. If you're selling raw goods, such as a grocery store, there's not going to be sales tax associated with it. In order to collect sales tax, you must go onto the state of Michigan website and fill out the unemployment agreement or the unemployment agency agreement in order to collect sales tax. You cannot collect it before doing that. Once you fill out that agreement, it takes a few days for it to be processed, but then you will also automatically be required to file monthly or quarterly sales tax returns, as well as remit those funds. The returns aren't difficult, they're like one-pagers, but sales tax returns, and it'll either be quarterly or monthly. Regardless of that, you will definitely have annual. So quarterly or monthly and annual sales tax returns with regards to the sales that you make. If you are doing online sales, there's a thing called Nexus. What Nexus means is that you have a physical presence there. So let's say, for instance, I am making cakes in the state of Michigan, and they are fully prepared. I owe the state of Michigan sales tax on the cakes that I sell, but then I also sell those cakes online. I sell cakes in Chicago, but I do not have Nexus, meaning I don't have a physical presence in Chicago. Those cakes that I sell in Chicago online are not subject to sales tax. So the ones in Michigan, because I have a physical presence, an office, kitchen in Michigan, I owe them sales tax. In Chicago, I do not owe them sales tax. I then hire my cousin to work for me who lives in Texas. My cousin sets up an office there in Texas to make his sales calls. Any sales that he makes in Texas are required for sales tax, because we have established Nexus I did not intend for that. We have established Nexus in Texas to collect sales, which requires sales tax. So just keep in mind, once again, NUXUS, I think the two X's is the company. But just sort of keep in mind, just enough information to give you to Google it and find out more information about it, but you may have sales tax implications. And so with that, I wanted to give a high-level overview of potential tax implications, tax forms that may be required of you as business owners, primarily your federal, your state withholdings taxes. They're going to be all filed, or federal state income taxes, they're going to be filed together. If you're in the city of Detroit, you're going to have local taxes. And then, of course, if you have prepared foods, you're going to have a sales tax requirement. Even if you don't have any sales, you will still need to file that sales tax return. If you don't file it, the state of Michigan will very kindly send you a letter saying you owe an inordinate amount of money that doesn't make any sense, and they're only doing that to incentivize you to send in the letter. They'll accept what the actual sales tax are. So if that's something that you haven't done, I would definitely start it immediately moving forward. So with that, my name is Dale Grant. My firm is Ashton Business Consulting. My contact information is on the screen. This training series has been brought to you by Eastern Market Corporation and in conjunction with Lake Trust Credit Union. One other note to mention, we've talked about Lake Trust Credit Union quite a bit. They have been kind enough to sponsor us for this event to provide accounting information. One thing they noted is that we've talked about businesses putting themselves in position for a loan. They did want me to mention that they do offer microloan products. Now, I have not personally seen those products. I can't tell you where they fall on the scale of loan products amongst all other loan products. What I can tell you is that what I've seen is that when organizations have made a commitment to put funds into the community, when they've made a commitment to work with organizations such as Eastern Market, typically they have made a strong commitment to make sure that those funds are getting into the right hands so that they can be the most impactful. So if that is something that you are considering, I would definitely at least visit the website. You may be interested in lines of credit. You may be interested in loans for equipment. You may be interested in commercial real estate loans. Lake Trust Credit Union, along with Eastern Market, and then along with the other number of organizations within the city of Detroit, we've got an amazing ecosystem of lenders, resource providers, organizations, technical assistance providers that are there to provide assistance to you all to help make you as successful as you can potentially be. And with that, I'm going to open the floor to any questions that we may have.
Hi, Dale.
How you doing?
Good. How are you?
I'm good.
I don't necessarily have any questions. I have a ton of notes. But I just wanted to say thank you for your time and all of your knowledge and expertise. It's been really helpful.
Well, good. I'm glad to hear that. I'm always happy to come out and share that information because honestly, I'm being very honest when I talk about the ecosystem and helping one with another because that's really what it's all about. So with that said, we've got the recording done. We're going to make sure Christine has the PowerPoints. We've got the recordings here. So anytime that you guys want to go back over and review this information, it'll be made available to you. And of course, you've got my contact information. So please, even if it's just a question, feel free to reach out and I'd be more than happy to assist. And with that, I hope everybody a good evening and take care.